Today we're going to be talking about delta neutral strategies and how to at least hedge yourself out of positions to make it reduce volatility if you don't like price movement or if you don't think the market's going a certain way, as well as finding ways to make semi-risk-free risk-free rates of return. So it's super cool and super interesting stuff. To start off though, we're going to talk about what is delta neutral strategies. So this is the definition on Investopedia. You guys can read it, but what they're saying is you're taking on positions that are having positive directions, so price goes up, positive volatility, negative volatility, so price probably going to go down, and so you're hedged out, so your total risk profile is zero. So you're not really worried about the volatility or sometimes with options and time decay stuff of what's happening. You're really caring about what is the yield that is being generated by the asset at that point. So traditional finance, usually dividend. In crypto, we're thinking about yield farming, so like uniswap V3 positions, or providing lending of more riskier assets, or providing collateral on perpetual futures, which is another form of lending as well. So let's go in a little deeper. As we start looking at delta neutral strategies, one of the biggest ones that's being run right now is by a protocol called Ethena Labs, or Ethena Finance. They are running a delta neutral strategy, and they've also tokenized the yield that's on that. So that's what's really big. As you see, I think on the top right of the screen, the TVL, they have 3.2 billion. Their yield is 12.3 on a semi-stable asset or stable bond, and then they have a whole bunch of users. Great. What is interesting about this is how they're actually achieving that yield. So they're running a strategy where they're longing ETH, so you would deposit, in their case, they want you to deposit wrap staked ETH, and then you are shorting on a perpetual future ETH as well. So you make yield from the wrap staked ETH, and then right now, because all of us are bull, we're long ETH, we think ETH is going to do really well, people are taking leverage positions, so they need to take out a loan or borrow money, in this case ETH, to go long on ETH even longer. So 1.5, 5x, 10x, whatever they are doing on their whatever time horizon. And so they have to pay for that leverage. And that's what Ethena has now been running, where they're earning that yield from people paying for the leverage that they're participating in the market, while also having a long spot position at the same time. So they're shorting it, which means they're deleveraging themselves while taking leverage by just being long that position. So if that makes sense, great. I'm going to go a little deeper into how that actually execute that trade right now. So now I'm on Avo, which is a perpetual futures platform. I'm going to show you how to execute the same trade that Ethena has been running. And the big difference, though, is they have made it extremely capital efficient because they've created that tokenization of the actual yield. But if you wanted to do it yourself, you can run it yourself, and you can earn a little bit, actually a lot more yield than what they're doing, because they're taking a cut off the top. So I'm going to go up here to the top right and click, I want to sell, which means I want to go short ETH right now. I don't want to do 20x. I definitely just want to do 1x. You don't need to take leverage on your short. So I'm just going to do 0.01. That's their minimum right there. And we place short. Amazing. We are now, taking on that market volatility. But because I seeded this account with Ethereum, I am holding spot Ethereum, which means I'm long Ethereum, and I am now short Ethereum, which means I'm expecting if the price goes down, I earn money. So I have subject to no volatility. What I do earn is what we call the funding rate, which is people that are out there trying to go long on Ethereum are paying me for my short position. So they're right now annualized, you're earning 11% or so. And this fluctuates, it was the other day, it was 38, and now you can see it was 28, a little bit above zero, but on average, it's going to be positive for shorting ETH and long ETH, so you're going to earn that yield right there. So we entered that position, we were able to showcase that we can now earn a yield off of being long ETH and short ETH at the same time, and that's kind of the risk-free rate for Ethereum right now, 10 to 11%, which is really good. Now, why is this useful or important? So in this case, I just wanted to I wanted to own Ethereum and earn a yield on it. I myself personally do this from time to time when I don't want to deal with volatility. I just want to get a consistent yield. But what you could do instead is there's a few other options. One, if you want to just use dollars, which is a little bit easier, Avo provides a low risk, low rate delta neutral strategy where you can deposit USDC in there, and they are projecting at 20%. It's probably be closer to 11 to 15, but it does the basis trade for you, so you know where the yield is coming from. Another thing I have been doing that is really cool is, there's an application that Noah loves. He's a big bull, big bull anyways, and it's called Pendle Finance. Let me go back real quick. And something I do is I look for some of the higher yield opportunities. These are pretty low right now, but Ethena is 76.8% fixed yield right now, which is awesome. This is annualized over the year, so you're earning whatever that is per day. So I actually just did the calculations real quick, off camera edits, and it is 0.21% per day, and there's, I believe, 27 days left in the duration of this contract. So that means you're going to earn 0.27 per day times 27, which is about 5.5% real yield. That's actually what it will be at the end of it, which is awesome. In this case, you would have to take on a buy spot Ethena tokens and then enter that position, which means you're now long Ethena. So you're taking on the price volatility up or down of Ethena, which is good and bad. So if it goes up, you're great. If it goes down, it hurts. So let's see. If we don't want to take that risk, we just want to earn 5% on the amount of assets we put in, which is great. We would actually go back over to Avo, go to trading, and I already pulled up the Ethena chart, and we would then take an equal amount of short position on Avo here. In this case, they actually have been paying funding rate out recently of 10 or 11%. It fluctuates. As you see, it goes down like minus 310, if the price goes up or down. But in general, it's been a positive experience for the past 3 or 4 months that this has been running. And so you now have a situation where you're going to, the next month, basically, you would earn 5% on whatever assets you put down. So if you, for instance, put down $1,000, you'd end up with $1,050. So your principal plus $50 more. Additionally, some of the Pendle pools have points associated with them, so you might get a little bit more juice to the yield. But super good opportunities there to be had, where you don't really have to worry about price fluctuation. You just earn what would be more considered a fixed income product. So super easy stuff. Happy to talk more about that in the Noah Dallas community. So feel free to reach out. Once again, my name is Caesar. You can find me on social at vcaesar, and looking forward to sharing more videos like this. Bye.